Good afternoon, and welcome to Thornburg Investment Management's 2026 Outlook webinar. I'm your host, Josh Rubin, a client portfolio manager for Thornburg. Joining me today is Christian Hoffmann, head of our fixed income, and Matt Burdett, head of equities. Christian, let's start with you. In the bond world, a coupon year is what I'll call a boring year. When the environment is pretty stable, bond prices are pretty stable, and investors' total return is essentially driven by the yield on their bonds. Many strategists say 2026 could be a coupon year for fixed income. How does that align with your outlook?
You know, having seen many of these outlooks for multiple decades, I would say that the idea of a coupon year for an outlook is actually something of a tried cliche. And I think you could go back and see that that is the most consensus call almost every single year. And if you go back and look what actually occurred during those years, you would find that it's actually very rare that you get a coupon year. And you can maybe try to unpack why it is that people call for a coupon year. And I think you could think about, efficient markets theorems, and also the fact that, what just happened is maybe likely to continue to happen. So it's kind of a cop-out in a way to say that we think that interest rates are fairly valued and credit spreads are also fairly valued. And if that's the case, and if I'm not calling for a catalyst, then the future should very much like the present, and we'll get a coupon year, and we won't have a lot of volatility. So why is that usually not the case? Because the world changes, facts change, and risk appetites change, and generally we have volatility during the year, and the world looks pretty different a year forward as it did in the past. Now, as we look at credit spreads from the beginning of 25 to the end of 25, they actually ended up in a similar place, but it was far from a straight line. And if I think about client conversations that I had a year ago when credit spreads were also quite tight, a lot of folks said, well, why wouldn't you just really lean into risk? Because the outlook feels fairly subdued, and why not just clip a coupon? I don't see any catalyst coming. And we actually pushed back on that and said, well, it's pretty rare that you actually see catalysts coming, and the way you price risk in general can be a risk factor. And so if things are priced to perfection, any bump in the road is likely to cause volatility and can cause drawdowns. We saw that very much during March and April. And if you look at high yield spreads, which is a good proxy for risk in credit markets, within 2025, you saw as tight as 250 to as wide as 450, during the year. And that was a year when, looking back, not a ton changed, but certainly there were periods of time when there was a lot of fear and uncertainty in the market. When I think about how we're starting the year today, there's an old adage that markets hate uncertainty. This period of time is probably the exception that proves the rule. There's a tremendous amount of uncertainty. I think we pulled up a graph of executive actions and in the first year of the current administration. And it's really unprecedented. And every single day we're seeing pretty notable changes, on the global geopolitical landscape, on the trade landscape, in terms of, how our relationships with other political powers are evolving. And we're doing that amidst the backdrop of pretty frothy valuations, not just in fixed income, but, in equity markets as well. Mm-hmm. So, I think this is, the exception that proves the rule, and I think you want to be nimble going into that and, being prepared to take advantage of opportunities, because I think this will be a year of more volatility and not less.